On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out in sunny and what seems to be shaky Scottsdale, Arizona.
Okay, my light fixture broke. Okay, wise guy, just
And
keep going.
with us today, though, we have a very special guest. Kristina Hooper is returning back to Buy, Hold, Sell. She is the Chief Market Strategist at Man Group. Kristina, we can close the book on Q3, but what a remarkable quarter! We saw the S&P up close to 8%. Well, for year to date, we're up over 13.5%. But for the fourth quarter now, our focus is there. What is Man Group telling its clients to expect?
Well, collectively, what we're talking about is really understanding what clients are concerned about and thinking through scenarios. So, my opinion is one in which I think we could see a variety of different scenarios unfold in the fourth quarter. Let's face it, we've had this incredible rally. Valuations are stretched. We're at 22 and a half times earnings.
Yeah.
And there is the potential that there could be some driver or multiple drivers, a confluence of events that could trigger some kind of a sell-off in this environment. So I think it's important to be prepared for a variety of different scenarios in the fourth quarter. We could see that rally continue, but we could also see a drawdown in stocks. And
Well, how does that work for your clients, Christian? In other words, I have many wealth management clients. We usually talk on a weekly basis, and like this today, I said, okay, we're up 165% this year, okay, because we're a growth portfolio. I'm going to take 25% of that, and that's going to go into cash as the Fed rates come down, where you'll make a nice little, 7 or 8% return, but I'm going to take down the risk. And everybody said, yes, Toby, thank you very much. How about your clients?
So I'm not talking to them about the nitty gritty. I'm more saying take a step back and ask yourselves, are you overweight? Especially, are you overweight US equities? But it seems to me that for those who aren't regularly rebalancing, chances are they do have some kind of an overweight to the US, especially US equities. So just a simple rebalancing can take profits and reallocate them to areas that have more attractive valuations. I also think we have to take a step back and ask ourselves, is the stock market at 22 and a half times price for perfection? And if so, do we really see perfection? One thing that concerned me was if you go back to April, we saw a high yield spread spike related to Liberation Day tariff announcements.
Sure.
But the spreads, high yield spreads came down quite significantly since then. So the recession risk that markets were pricing in April seems to have gone away, and yet nothing's really changed. I mean, we still have tariffs. We still have a lot of tariffs. They're being, more are being announced on a regular basis. So are we misunderstanding or mispricing recession risk in the US? So those are, I think, are just some important questions to ask as part of an assessment of one's portfolio at the end of the quarter. And again, then, is sentiment too negative in other parts of the world? Is there upside potential in other parts of the world? And I think about Europe, where there's an incredible amount of stimulus will be going into the European economy over the course of the next few years because of the commitment to increase spending on defense and defense adjacent infrastructure.
Yeah, I'm looking at our portfolio for international. Korean, the SKE is up like 36%. Germany's up about 29.5%. Even frickin' France and Italy, who still don't really understand economics, are up, 20%. So it feels like they've always been undervalued. The PE ratios have always been much lower than the United States American stocks because of their non-robust economies and because of their taxation, blah, blah, blah. But I'm totally with you that if someone's just 100% in the United States stocks, and you're missing out on plus they pay dividends, by the way, as you know, that's to me a great way to spread your risk. And they're not correlated at all with the U.S. stock market.
Well, and I think taking diversification one step further and make sure you're broadly diversified, not just within equities, but also within fixed income and also within alternatives, and having adequate exposure to alternatives.
And what do you call an alternative these days?
Oh, well, there's a lot that fits into the alternatives category.
Yes, there
of course, private credit, private equity, hedge funds, gold, catastrophe bonds, I would argue is an alternative asset class, although some might stick it in under fixed income. Some view convertible bonds as an alternative, even though most put it in fixed income. But the point is, it is really important at this juncture, given all the uncertainty out there, to be well diversified, to be prepared for different scenarios. I think we've seen some of that already this year, in that you've seen stocks rally at the same time gold has rallied. That's a hedging of bets, so to speak.
Well, I've been bragging about our gold miners, the GDXU, that we've had to trim twice because it's been up, gold miners up 110% in 6 months. I'm feeling my age. The last time I remember that was 1979. So I'm with you. How much percentage gold would you recommend someone have in their portfolio? And by the way, I have a prejudice against, I want to own the miners, not so much the gold. And the same thing in silver and the same thing in platinum, because they're just so leveraged to these price increases that I believe are due because the dollar's down 11.8% against the rest of the world. What say you?
So I would argue that while of course everyone's risk tolerance is different, their goals, their time frame is different, but a rule of thumb is about 3 to 5% allocation to gold. Interestingly, I think there is a case for diversifying from just owning gold and also having exposure to the gold miners. Historically, they've traded at a discount to gold, and so it's certainly an attractive play, and again, a way to diversify.
Yeah, also so they're paid off their debt. I mean, they've had these huge debts, and now they're not only cash flow positive. Some of these guys that we own, there's no more debt. I can't believe it. Mining, no debt. Come on.
So on the 3 to 5% allocation for gold, though, is that because of the state of affairs currently, or is that just a typical allocation that you would possibly recommend for somebody with, say, a proximity decades away to retirement?
So I think particularly in this environment, but certainly some allocation, even if it's just 2% for the long term, makes sense. I just think that right now we do have heightened risks, including geopolitical risks. And in addition to that, of course, we have a real issue with US Treasuries, in that they're not necessarily the safe haven asset class that they have historically been. Certainly not in the minds of a lot of investors. And so to even just diversify one's exposure, adding to a US Treasury allocation with gold, I think gives diversified exposure to what are perceived to be safe haven asset classes. Keep in mind, the US is running bigger and bigger deficits. Fiscal sustainability is a real question mark. We have bond vigilantes circling in the water.
I haven't heard that term in a while.
Well, it's a good one, and I got to credit Ed Yardeni back in 1983 for coming up with it. But there is a real argument for diversifying safe havens with gold.
Yeah, I'm totally with you. We have rates that are being cut by the Fed. We now have 2 more already priced in this year. How do you play that, or how does that affect your viewpoint, I should say?
Well, I think it's important to note that there have been times in history where the Fed has cut, but 10-year yields have gone up. And I think we are in that scenario today. I think we're likely to see the 10-year go up. I could see it getting up to 4.75 in coming months, maybe higher. There is, in my opinion, continuing reduced tolerance for the kind of deficits the US has been running. I think the exorbitant privilege is getting chipped away just because there are certain countries that are focused on de-dollarization. And that is a very real threat to the way financial markets in the US have worked for a long time, and really globally have worked. So to me, there's a very real risk that yields go up from here, regardless of what the Fed does.
Yeah, I mean, I'm with you. It's sort of intriguing that China has not only de-dollarized, but they're, according to the records I get on a daily basis now, their central bank's the largest buyer of gold, net. They're selling dollars and they're buying gold, and I think that's a reasonable response for essentially, being in a tariff war with your largest trading partner. The fact that the dollar is down so much against the renminbi, against the, I mean, it's stunning. By the way, but doesn't that help the U.S. exporters when they're selling over to Europe, et cetera? That now that they're getting your customers getting a 10% discount on what they used to pay.
It does in the shorter term, but we have to think about all the knock-on effects, because if the tariff wars work, right, if the U.S. reduces consumption of foreign goods, the end result is that there are fewer U.S. dollars in foreign hands. So there are fewer U.S. dollars looking to be invested in assets like U.S. treasuries. So do we shoot ourselves in the foot because we've reduced the pool of potential buyers for U.S. treasuries, thus driving up yields?
Yeah, but we now have a crypto that owns $800 billion of U.S. bonds. I mean, whoever thought of that?
It is fascinating to see just developments and how a move towards something innovative actually means that there could be buying of an old standby traditional safe haven asset class like treasuries. But you're absolutely right.
Yeah, stable coins were the largest single buyer, according to the data I get, of the 10-year treasury bond. I was gobsmacked.
I saw that there's certainly a lot of interest and buying going on. Although my understanding is the Genius Act is really focused on buying the shorter term debt to back up stablecoin.
Yeah,
Kristina, expand a little bit more on the Fed. What are your thoughts? Should the Fed have cut sooner? Do you believe that they need to cut more? What do you think?
So I don't think the Fed should have cut any sooner. I think we're certainly seeing a weakening in the economy. I'll call it sick canaries in the coal mine. They're not dead yet, but there's definitely a weakening. We're seeing it in the jobs picture. The long-term unemployed as a percentage of total unemployed has crept up to 25.7%.
Yeah.
I used to follow that really closely coming out of the global financial crisis, and I'm following it again because it is elevated. So there are a lot of signs that the economy is weakening, but they're pretty recent signs. So I think the Fed was right to be careful and thoughtful and wait until September to cut. Should they cut going forward? I think so. I think they've decided that inflation's not going to be a concern because it's going to be tariff-related inflation. It will be sort of more of a one-time price shock, and that the concern should be around the economy and deterioration there. So it seems right to get about 2 more cuts this year and perhaps get a few more next year. Of course, so much will be dictated by the data, and we just don't know. Sometimes, as Chris Waller has pointed out, when the labor market starts to deteriorate, it can happen really rapidly. So we have to assume or expect that the Fed will be open to a variety of different paths going forward and could very well be sensitive and react to any kind of major deterioration in the labor market.
Yeah, so the dual mandate story is interesting because we now have as you say, the unemployment rate, also the duration of unemployment, which is the one that I look at the most, and then in the kids. I mean, the under 30-year-old is as high as I've ever seen it in a normal economy. They don't spend that much because they spend everything they get. But do you see what would make the employment situation get better, I guess is what I'm asking.
Oh, that's a good question. Well, you could certainly see job openings increase if we do have a continuation of the aggressive immigration policy we're seeing.
Yeah.
But that comes with a caveat because I think we're already starting to see something of a mismatch. Yes, there are still a significant number of job openings, and yet long-term unemployed, that 27 weeks and over, is elevated.
Yeah.
And so that suggests to me that those who are looking are higher skilled. Um, they're looking for higher skilled, higher paying jobs, the ones they used to have. And what's open is lower skilled and lower paying. So that can be quite problematic, and that mismatch could be exacerbated over time, particularly given technological innovation, AI. And I think, when we speak specifically about young people and unemployment, like the class of 2025 graduates from college, a lot of them haven't found jobs yet. I think we can point to the finger at least somewhat at AI. And, we've heard it on recent earnings calls. Companies are feeling a lot more comfortable saying that they're using AI, it's making them more efficient. They need fewer entry-level employees.
There's no question. I literally use Perplexity and use Claude, use ChatGPT, at least an hour and a half a day, just for equity research, just for economic research, et cetera. That was the work that I started doing, when I was out of college. Well, sorry. I mean, first off, they don't talk back. Now, number two, they show up. They don't. I don't have to worry about them showing up on time. And then, but most importantly, when you go into deep text or deep research mode on these things, OMG, I'm getting content with it's 100%. Has every source linked to every source. You would take me 2 days to do what I can do in 25 or 30 minutes. And that's a massive game changer. I have friends in the real estate business who I'm an investor in a platform for real estate developers and real estate companies to figure out, what's the apartment worth? What's the 3 apartments around there worth based on this, so and so and so forth. And that's what you used to have a junior, JV person go out and do. And now they get it in 3.5 minutes.
Yeah.
Yes.
That's remarkable.
But I would give the caveat. We have heard a few scary stories, right? AI blackmailing software engineers when they hear they're going to get shut off. And also, there have been incidents of lawyers utilizing AI, and AI, not dissimilar to the humans, it's attempting to replicate lies and makes up case law that doesn't exist. So I do give those, I take it with a grain of salt, recognizing though that there are significant productivity gains coming from it. Unfortunately, though, we have to ask ourselves what happens 5 years down the line when there is a large cohort of unemployed young people who haven't gotten the experience, haven't gotten that entry-level experience that is so critical for the rest of their careers. That is a concerning question.
I'm with you. I tell every person under the age of 35 that if they're not taking these online courses on how to prompt and how to use AI like an old, dude like me has, it would be literally like they were, to go work on the railroad, but they were afraid of speed. You have to. This is a primary skill set that anyone has to have, but particularly if you're dealing with, data, dealing with math, dealing with all sorts of things that you can do better, faster, cheaper if you understand how to write a prompt. And I, that worries me because I've seen a lot of young kids here in the 25 to 30 age group I play golf with, and the ones who are killing it are obviously the ones in tech, and they're obviously the ones in professional services. But those ones in professional services are like, man, am I gonna still have a job? When all the research work that I did, you just sold us this system that does it in 2 minutes.
Right.
Yikes.
Yeah, Kristina, let's turn the page here on the looming government shutdown. Should Wall Street be concerned at all?
I think that's a great question, Todd. And based on history, especially recent history, it
Yeah.
doesn't seem Wall Street should be concerned at all. We've seen probably in the last 6 shutdowns, I think almost all of them, the S&P 500 was up. In fact, the
Yeah.
most recent, like 34 days, the longest, the S&P 500, I think, was up more than 10%. So on its face, I think there's nothing to be concerned about. I do think there are some concerns, some things in the back of my head that I worry about. Sort of the threat to lay off a lot of federal employees permanently as a result of this shutdown really worries me. The federal workforce is actually at a very low level
Yeah.
relative to history, and you don't want to lose any essential functions. What we saw with Doge was that a lot of people were fired that were necessary, and like those working on the avian flu and those who were nuclear scientists, and so they had to be brought back. And so you worry about things like national security, pandemics, that kind of thing. I think that goes into sort of the full faith and credit of the U.S.'s position as a safe haven. All those things are at risk when you see any kind of decimation of the federal workforce.
So with
Wow.
if the shutdown goes on for a few weeks, as you know, the Fed meets again in 4 weeks. What if they don't have the BOS numbers or even the CPI numbers? What exactly would they do at that meeting?
That's an incredibly good question. And in fact, the last shutdown I said lasted 34 days. That would take us beyond the next Fed meeting.
Yeah.
I think that's going to be a tough one. Hopefully they do get some data. Let's face it, it's only a couple days before the jobs report is to be released. So most of that is probably already assessed and can be shared with the Fed. So hopefully the Fed isn't fully flying blind, but that is one very compelling reason to not have a shutdown or end it very quickly.
Well, Kristina, I want to know about the AI trade because it happens to, allow me to live a life of luxury here so far. What are the main drivers? We call it sort of the big 8 in AI, just price to perfection, and you need to look in the second tier, third tier to continue to grow your wealth.
Well, I certainly think there's something to be said for not just looking at PE ratios. We have to look at PEG ratios, but for most, there is an incredible amount of earnings growth projected,
Yeah.
which I think helps support valuations, helps support stock prices. But certainly, we want to look for opportunities that may be overlooked and find
Like
those
what,
areas.
Kristina? Like what, he asked.
Well, that's the $64,000 question. Of course, last year it was data centers, it was utilities, right? As people thought about the food chain, and I'm sure that some of the smaller names that are getting more involved in AI and selling more of their products to the AI supply chain to become part of the AI supply chain. I think there's definitely opportunities there. I think we have to keep an open mind. Sometimes it is that which isn't entirely logical that we realize is benefiting from or part of one of the beneficiaries of the AI trade. It is, I think, when all is said and done, it's going to be a pretty long list of beneficiaries.
Yeah, $2 trillion is still a lot of money. One that got me was interested. I mean, we were owning silver for the same reason why we own gold and own platinum. But there's like 42 kilograms of silver that goes into every data center, module. So when you look at the amount of silver that's being mined versus what's available, and then you do 42 kilograms, times 2,000 data centers, 3,000 data, that's a lot of silver. And that's a lot of copper too.
Yeah, and Tobin, that's the perfect example of, it's sort of working through what is benefiting from AI, and there are a lot, and commodities are part of the story.
Yeah. I mean, also, fiber optics, good old Corning, right? I remember Corning in the Wayback Machine, right?
Absolutely,
in 98,
late
99,
90s, very,
right?
very hot.
And now there's companies that are particularly fiber optic. You can't run these things without fiber optics. They have to have fiber optics. They have a majority share of that. And then there's a company called Credo, CRED is the ticker symbol, that connects the Corning fiber to the data center servers, etc. They've all had fantastic runs, but I'm with you that as you go down the food chain, and it's certainly, I mean, we added Sterling, the manufacturing company, because they're building 42 different data centers right now. They used to be good old like building natural gas plants, or whatever, and now they have 42 friggin'. I mean, have enough work for the next 20 years. And no one ever thought about that sort of as a technology. But now I'm with you that the people who build the technology where the technology goes and do the power, et cetera, that's just as important. It all doesn't work without power. It doesn't work without corn.
Pretty amazing. Pretty amazing. So, yeah. Kristina, we're going to leave it there on that final note. We appreciate you joining the show today. I know you've been very busy at Man Group, so there's probably a lot of quarter end and quarter to happen commentary you got to put together. But we do hope to have you back on once again very soon.
Thanks so much, Todd.
Absolutely.
Great to have you on, Kristina. And next time you're going to give us your guess for 2026, because I'm already in. I don't care about 25 anymore. I want about 26.
There you go. So on behalf of Kristina Hooper and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care. All right, we are out. Kristina, that was fantastic.